Hello, and welcome to Bartlett's Winter Strategy Update webinar. I'm Holly Mazzocca, President of Bartlett Wealth Management, and the moderator for today's panel conversation. Today, our panelists will reflect back on 2025 and then turn their attention to opportunities that lie ahead for 2026. There's been plenty of news driving the markets since we last gathered for our fall strategy update back in October. And based on the number of questions that have come in during the registration process, I'd say all of you on here with us today agree. We'll answer those questions at the end of today's conversation. We'll also leave more time for conversations and questions that are submitted during today's presentation. So please utilize the chat functionality, the Q&A functionality at the bottom of your webinar screen to submit your questions. With that, let's introduce today's panelists. We'll start with Justin Ellis, Wealth Advisor and Principal. Justin will share a look back at the stock market in 2025 and then share an update on where our Bartlett team sees equity market opportunities for the year ahead. Next up, John Finkler, Head of Fixed Income Services, will get us up to speed on the bond market. He'll provide thoughts on where we see changes in the bond market based off of the new landscape within the Federal Reserve, and we'll also discuss the dynamics around the US dollar. Our third speaker today is Gina Slayton. Gina is a wealth advisor and financial planning team lead. She'll talk about the importance of revisiting your financial plan and looking for opportunities to rebalance following these strong years in the stock market. She'll also highlight important tax updates and resources within our Bartlett team that can assist you in your tax planning work. With that, Justin, I'd like to kick it off with you. Let's look back over the past year. How did equity markets perform in 2025? And how does that impact your thinking about portfolio positioning as we look ahead?
Well, 2025 proved to be a great year in the stock market. The U.S. markets continued a strong run that began in 2023, with all markets, large, mid, and small cap, achieving returns north of 10%. You may recall this is in the same year during which the S&P 500 was at one point down 19%, just missing the definitional threshold of a bear market. This speaks to the value of maintaining a disciplined, long-term approach when investing. This is something we speak to regularly at Bartlett. Maintaining a pragmatic view, preparing for the inevitability of volatility, and letting history and fundamentals be our guide. One more thing I'll highlight to put this current market cycle into perspective is that the US markets had a 3-year cumulative return of 86.1%, which amounts to the 10th best 3-year rolling return period in the last 87 years of observable data. Just incredible. While it's easy to get complacent in the midst of a bull market, buoyed by strong earnings, AI enthusiasm, and economic resilience, it's important to remain rational and grounded in reality. Bull markets don't last forever, and we see reasons to remain cautious. Uncertainty persists surrounding tariffs, interest rates, inflation, and the geopolitical landscape, to name just a few. A little later in our presentation, Gina will touch more on why we are diligent in rebalancing our clients' portfolios and believe it to be a key component in our risk management process. Another guiding principle at Bartlett has been the importance of diversification, which certainly added value last year. While international equity markets have not experienced the same level of growth as US markets in recent years, you can see in the chart that both the developed and emerging markets finally had their day in 2025, outperforming US markets by a healthy margin.
Justin, you bring up an interesting point on the international equity markets. Can you provide some insight into what led to their outperformance over the past year?
Yeah, let's get into why international markets had such a strong year. This chart shares a breakdown of the components that drove equity returns for the global markets, excluding the United States, in 2025. The gray section represents valuation. Valuation is a measure of expectations of investment fundamentals and investor optimism. And valuation increased for the international markets last year, reflecting increased optimism, partially driven by an expectation supported by recent data that European states are increasing spending as the global order shifts. Some of the beneficiaries in 2025, unsurprisingly, were European financial companies and aerospace and defense companies. The increased valuation we experienced in 2024 foreshadowed the increase in actual earnings that followed in 2025, which is represented by the green portion of the bar graph. We shared data on drivers of international equity returns in our strategy update webinar last June and highlighted how at that point in time, there had actually been a decline in earnings growth over the previous 12 months for that market. Obviously, we're seeing a shift in momentum in this area, as you can see the increase in green portion of the bar graph from 2024 to 2025. Lastly, the weakening dollar environment continued to contribute to returns in 2025, accounting for nearly a quarter of the performance. This is represented by the blue section of the bar chart, and the justification for that, or really the reasoning, is that given non-dollar earnings need to be translated to US dollar, a weaker dollar benefits US investors with international stock exposure. To put it simply, international stocks had the wind at their back in terms of expectations, fundamentals, and the weakening dollar.
Thanks, Justin. That's a really helpful recap as we look back, and we'll dive more into the international markets and the importance of the US dollar as we go forward. John, I want to bring you in here. Let's take a look at the bond markets. How did bonds fare in 2025?
While not nearly as eye-popping as the stock market performance Justin just walked through, bonds did quietly deliver a strong year in 2025, proving that even fixed income investors like me can get excited on occasion. After a volatile start to the year, most notably marked by uncertainty surrounding the administration's April tariff announcement, in addition to a Moody's downgrade of U.S. sovereign debt, bond markets ultimately found their footing. As the year progressed, yields moved lower, supported by 75 basis points of rate cuts from the Federal Reserve. Those cuts, which occurred in the fall of last year, were driven by signs of labor market softening and increasing confidence that inflation would continue its downward trend. In that environment, bonds did a lot of things right. They delivered positive returns. They produced meaningful income thanks to higher starting yields and rewarded investors who took the opportunity to rebalance after a few strong years for equities. Now, the year was not without bumps along the way, especially early in the year, but volatility faded as the headline-grabbing events passed and the Federal Reserve's path became clear. This chart really highlights the broader story of fixed income in 2025, using a mix of broad market indexes and a few of the sectors that we focus on most in our strategies. Yields started the year at higher levels, which gave bond returns really a strong base to build on. As rates moved lower, returns were broadly positive across the market, with most major categories posting mid to high single-digit gains. Higher yielding, more credit-sensitive areas led the way, while high-quality investment-grade bonds also benefited meaningfully from the decline in rates, marking their strongest year since 2022. Overall, it was really a strong year for fixed income across sectors, not the kind of returns we should expect every year, but certainly a welcome outcome and a good reminder of what bonds can deliver in the right environment.
John, a chart like this will make even the bond team smile, right? I mean, these are pretty powerful returns, and it's easy to lose track of this valuable role bonds can play amid this bull market for stocks, but really great to see the results as we look back. Gina, let's turn to you and explore how we manage risk given the strong results, especially in the equity markets. How do investors think about risk management and rebalancing as a part of their overall financial plan?
Yeah, as Justin and John have shared, markets really have had quite the extraordinary run over the last 3 years, even factoring in some of this year-to-date volatility. Now is an excellent time to pause and reassess your overall investment strategy. Especially when times feel uncertain looking forward, your Bartlett team is here to help you stay disciplined, avoid any panic, and truly uncover opportunities that benefit your family, your finances, your taxes, and even your community impact. That first step is to revisit your asset allocation within the framework of your personal financial plan. Rebalancing really does matter, especially after these few years of strong double-digit market returns. Your portfolios may have drifted to a risk level that no longer matches your comfort level. We're not saying by any means that risk is inherently bad. We know that long-term investors are usually rewarded by taking on more risk with more return. But it's that misaligned risk that deserves a closer look. If you're someone who feels uneasy when markets reach near all-time highs or during bouts of volatility, this could be a signal that you have too much stock exposure or that your particular mix of stocks and bonds are not the right fit for you anymore. This is a great time to look at rebalancing. We have an example here showing the value of rebalancing. On the left, the original allocation for this portfolio was determined to be 60% stocks and 40% bonds. Taking in these historical returns that we've been discussing, after 5 years without any rebalancing, that stock portion has risen to 75% of the account. More drastically, if you look at 10 years of an account remaining untouched, the stock portion is all the way up to 83% of the account. It's a much riskier profile than the originally intended 60-40 mix. Rebalancing decisions of how much and when are definitely not made in a vacuum. We at Bartlett work to understand your full picture, which is why it's best to revisit that financial plan with your team. They definitely know you and your unique situation best.
Great point, Gina. And when I think about how these portfolios evolve over time, there are a lot of clients with significant taxable gains, unrealized in their portfolio, but they may feel constrained to realize those gains for one reason or another. Are there any creative solution for these scenarios?
Absolutely. This is a very common circumstance, and we're going to ask a few questions to dig deeper on what's right for you. First, we're going to start with the account types. What do you have, and how does this play into your ability to rebalance? If you have IRAs, a traditional IRA or a Roth IRA, great. You can rebalance inside these type of accounts without any tax impact. If it is in fact a taxable account, then that's a little bit of a different story, and we have to dig in to understand your capital gains budget. So that really is where we go next. That's the next question. Let's start to map out your 2026 tax picture and establish some sort of tax budget for the year. We're often asking clients for their tax return, and this is a big reason why. We're definitely not afraid of realizing gains if that's the right decision for you. Gains, of course, means that your investments grew. But our goal is to avoid unnecessary gains that may impact your taxes, your deductions, even Medicare costs negatively. We have great tax analytics tools at Bartlett, some of which we'll dive into in a specific example later. But even with that, we want to be coordinating these decisions with your CPA to make sure that everything aligns together. A third factor is understanding how you're using each account. What's the purpose here? Are you taking regular withdrawals? Are you in RMD, required minimum distribution status from your IRA? If so, it can be a great idea to start raising some of that cash now for upcoming expenses. Even with this, it doesn't mean that you're changing your long-term asset allocation. It's simply a prudent money move to raise cash now for a spend that you know is upcoming in the short term. On the other hand, are you adding regular contributions or expecting a large lump sum into the account? In this case, we can actually rebalance with the new dollars to reach your intended asset allocation mix without any selling required. Maybe you're leaving this account largely untouched. Is it for legacy or inheritance goals when you're gone? In that case, there might be a longer time horizon, which could justify a higher risk reward profile. And lastly, really with you, has your own risk tolerance changed? We know that life circumstances can shift your comfort with risk, and real world experience shape that perspective overall. Maybe your spending has changes or something, maybe your spending has changed or something's going on with your health or your family that deserves a consideration here. All of this is grounded in the reality of your own ability and willingness to take on risks. We know that markets are unpredictable. We've talked here already about some of the disruptions last year of DeepSeek in January and Liberation Day in April. None of those were expected, but we do expect certain market disruptions. That's why flexible, personalized planning is really what matters. We're here to ask a lot of detailed questions, we know, about your spending, about your cash flow and family circumstances, but we want you to be ready. The goal here is to help you strike that thoughtful balance between making sure your short-term needs aren't exposed to undue market risk while giving your long-term assets the best chance to grow by staying invested. And so that's the heart at what we're trying to do here. Align all those actions with the long-term success of your plan.
That's a great point, Gina, on how the plan and the tax situation really help drive some of the decisions that we might be customizing on the investment side of our work. And Justin, I want to turn back to you and dig back in on the forward-looking picture on the investment side. We received a number of questions asking where we see opportunities given the strong run we've experienced. Let's talk a little bit about what you see when you look ahead in 2026.
Well, we still see potential for strong returns in the large cap domestic landscape this year. And there are signs that returns can be strong beyond just the so-called Magnificent Seven stocks that we've spoken about during past strategy updates. Those include Amazon, Apple, Alphabet, Microsoft, Meta, Nvidia, and Tesla. We see the broadening of returns in the large cap space to the other 493 stocks in the S&P 500 as one avenue for continued market strength. The Mag 7 earnings growth, which really has been the dominant driver pushing the S&P 500 to all-time highs, has moderated as the Magnificent Seven companies continue to increase their spending on AI-related endeavors, while the remainder of the S&P 500 shows signs of earnings acceleration. In fact, the Mag 7 group actually underperformed the broader market last year. We also believe there are opportunities beyond large cap domestic stocks. As mentioned, there are a few factors that drive market performance. Investor sentiment, reflected in the price that someone is willing to pay for a stock, and fundamentals, like earnings growth expectations and dividend yields. Let's spend some time on this next chart that compares the key market exposures of client equity portfolios by valuation and expected return, which we reference to help us identify market opportunities. The horizontal axis represents each market's valuation, a relative measure of how expensive a market is. Out on the far right are US large cap stocks, currently the most expensive market. The vertical axis represents the expected return, measured by projected earnings and dividends. Ultimately, all else equal, the ideal investment has a high expected return towards the top of the chart with reasonable valuations, more towards the left side of the chart. Two areas that appear attractive to us and warrant timely allocation in client portfolios are U.S. small cap markets and the emerging markets. U.S. small cap stocks have a promising earnings outlook due to a few underlying factors. Firms can benefit from lower interest rates, an improved real economy, and the potential for productivity boosts as AI tools mature and adoption accelerates. That, coupled with the shift towards deglobalization and growing demand for infrastructure and manufacturing in the United States, sets up for a strong cycle for small cap domestic stocks. Strong earnings and a more reasonable valuation make for an attractive opportunity. Emerging markets similarly look attractive due to their reasonable valuations and expectations for 20+% growth in earnings, which seems to be driven by positive momentum after deglobalization trends and the impacts of individual country tariff negotiations have become clear. As we mentioned before, the weakening dollar could continue to act as a tailwind in this space as well. We displayed this next chart to give some insights into something we at Bartlett are paying close attention to. Historically, the dollar tends to move in multi-year cycles of weakening and strengthening. The gray shaded timeframes in the chart represent periods where the dollar is weakening. The blue portion of the chart represents the relative performance of international markets versus US markets. So the periods where the blue graph is shaded up, the US markets have outperformed, and when the blue portion is shaded down, international markets outperformed. As you can see, there's a high correlation between periods when the dollar is weakening and international stocks outperform. While it's difficult to predict how long these cycles will last, you can see that we do find ourselves in an environment where the dollar is weakening and international stocks outperforming. John will discuss why the dollar has been in a weakening trend a little later in our presentation.
Justin, it's really interesting to see this correlation between a weaker US dollar and strong international stock outperformance. Judging by what you've shared so far, though, it can be difficult to perfectly time these cycles. How do you think about that?
Yeah, it's definitely true, and a huge reason why we're always looking to maintain an all-weather portfolio for our clients. And we intentionally avoid attempting to time the market. We understand the follies associated with that, but it's also important to note that a weakening dollar has historically benefited more than just the international markets. This next chart here gives us a broader historical context. The gray bars in the chart represent the overall performance for the US, developed international, and emerging market performance from 1988 to 2025. The green bars represent periods during this time frame when the dollar weakened, and the blue bars represent periods when the dollar strengthened. The reality is that while a weakening dollar has proven to be good for performance of international markets, domestic stocks have also performed quite well. This partially reflects the fact that the S&P 500 is made up of multinational companies with revenues that are derived from non-dollar currencies. So as the US dollar weakens, US multinational companies' goods become more affordable to international buyers, potentially increasing demand. It can't be ignored that the outperformance from international stocks is significantly more pronounced when the dollar is falling compared to their overall return. So you combine this with the growth in earnings and more reasonable valuations we discussed earlier, and we arrive at our thesis to ensure our clients have exposure to international markets in their diversified equity portfolios.
Justin, I'd like to build on this conversation around the US dollar and John, bring you in here to speak a little bit about some of the factors that are driving the dollar's performance. Can you help us dig into that a little bit more?
Yeah, this recent weakness that we're seeing in the US dollar really comes after more than a decade of strength. And that includes especially strong gains coming out of the pandemic, where we saw strong GDP growth along with higher inflation, which really led to higher interest rates in the United States. And it was this environment that really made dollar-based assets very attractive to global investors. As we've alluded to, that trend has reversed. And last year, the dollar index fell nearly 10%, and year to date, it's modestly lower. And now there's multiple drivers behind this weakness, including softer US growth expectations. You have uncertain trade policy. You have political pressure on the Federal Reserve, and you have lingering fiscal concerns related to the US debt and deficit. But I think the dominant factor has really been interest rates, both domestic and global. Not only the move in rates over the past year, but near-term expectations as well. Highlighted in this chart are all the global central banks' rates, with the Federal Reserve shown in black. Now, this chart is very busy, so I don't want to get too caught up in the absolute levels, but rather focus on the trends from last year, shown by the left side of the chart, and more important, the expectation of what's expected to happen in the future, shown by the right side of the chart. What was an environment with central banks moving generally in the same direction, in other words, lower, has changed to an environment with most central banks moving higher, except one key bank, and that's the Federal Reserve. The US is one of the few countries where rates are expected to move lower. So why is the dollar declining? Well, to a major extent, it's because interest rates around the rest of the world are rising or expected to rise in the near future. With the Federal Reserve cutting rates last fall, and perhaps more to come, the interest rate advantage that once supported the dollar is simply fading. And it's this shift in rate differentials that's encouraging investors to reduce exposure to US assets and allocate more capital abroad where growth prospects and yields are improving. Now, looking ahead, the dollar's direction will largely depend on US economic performance and whether the Federal Reserve might be successful in reducing interest rates further, with faster reductions increasing the risk of further dollar weakness as investors search for higher returns outside the US.
Really helpful context to see that picture and just see that black line of the US is the only one that is trending downward. John, let's broaden out a bit more and look at overall opportunities within the fixed income market. I know the Federal Reserve has been in the headlines quite a bit lately. How is your fixed income team thinking about the impacts of changing monetary policy, and what impacts that might have on the overall bond market.
Yeah, so let's take a step back and think about monetary policy in context. Despite the persistent headlines around the Federal Reserve, from leadership changes to investigations that have raised questions about institutional independence, I think the markets really remain focused on the fundamentals. And both the Fed and investors are signaling that we're very late in this policy easing cycle. The policy rates now sit within roughly 50 basis points of the Fed's estimate of neutral, which is a level consistent with an economy operating at full employment and stable inflation. So, in other words, with the data that we have in hand, the Fed does not foresee significant adjustments to short-term rates from current levels, and that's barring any material changes that we might see in economic conditions. So as a result, we think that monetary policy is really beginning to fade into the background rather than dominate markets the way it has in recent years. And you can see that shift clearly in interest rate volatility as measured by the MOVE index, which simply tracks the volatility in US Treasury yields. Now, to better understand, you can look back to periods such as early 2023, when the economy emerged from COVID, or more recently, the tariff announcement in April of last year. After nearly 4 years of elevated rate volatility, the past 6 months have seen volatility fall back toward more normal levels. So, with interest rate swings no longer dominating the day-to-day market moves, fixed income investing becomes a little bit more straightforward, and it brings the focus back to fundamentals rather than the headlines.
I think that's certainly an encouraging development in the bond market. And given what we've heard from Justin about the strength in the equity market and from Gina on the importance of rebalancing, when clients are thinking about this fixed income exposure, can you help paint a picture of what return expectations could look like as we look ahead?
The starting yield has historically been one of the most reliable indicators of forward-looking fixed income returns. When comparing the starting yield on the 5-year Treasury to the subsequent 5-year total return, the two have tended to move closely together over time. So entering this year, the 5-year Treasury yield was approximately 3.75%, which we believe provides a solid foundation for future returns. Today's interest rates remain attractive in our opinion, and barring any unexpected change in the outlook, we foresee a very range-bound yield environment, and it's this stable rate environment that allows investors to earn attractive income. While some sectors appear expensive when viewed through a traditional valuation lens, they continue to make sense from a yield perspective, particularly in an environment where income is a primary driver of returns. Areas such as investment-grade corporates and the mortgage market offer attractive all-in yields that can be earned without relying on further spread tightening. Municipal bonds also stand out as compelling, supported by their high quality credit profile and the strong financial position of state and local governments, which today benefit from elevated reserve balances and well-funded rainy day accounts. So taken together, these dynamics really support a favorable backdrop for income-oriented fixed income investing.
Thanks, John. I think that helps paint the picture of where there's still opportunities on the bond side of a diversified portfolio to really provide that risk mitigation while still offering a very attractive income level. Gina, I want to turn back to you. In the early months of 2026, what financial planning topics are driving your client conversations?
Now that we're in the end of February, a big driver is gearing up for tax season. So we're still focused on digesting those impacts of the 2025 new tax legislation, the One Big Beautiful Bill Act or OB3 Act, and how that affects our planning for clients. I know we covered the OB3 in detail last summer. I do think it's helpful to give a quick reminder of some of those key provisions that we're tracking. This is definitely not an exhaustive list, but it's nice to take a reminder here. So at the top, we have income tax brackets were made permanent. That top tax bracket remains at 37%. The lifetime estate exemption increased to $15 million per person. There's a new enhanced senior deduction of an additional $6,000 per eligible tax filer, some income phase outs there. The SALT deduction, state and local tax deduction cap, was raised from $10,000 to $40,000, also with income phase outs. And a couple of new ones for 2026. There is a limit on the overall charitable deduction for itemizers. And another new one is there's a limit on the overall tax benefit for itemizers in that very top 37% bracket. So our role is to take all of this into consideration, weigh the costs and benefits of where we are in today's tax code with that historical perspective guiding our long-term decisions. We know that sometimes good planning can mean intentionally recognizing income or gains to produce those better lifetime tax outcomes. So here's an example of some of that tax planning that we're doing behind the scenes of building out the tax picture for clients, especially as we're gearing up for tax season. We have a sample client here, John and Sally Smith. They're ages 70 and 67. We can see on the left, they've done quite well for themselves, amassing significant assets. They have $3 million in a joint revocable trust, $2 million in their combined IRAs, and a paid off primary home. We can see right away that they have a diversified mix of account types, so that means a mix of tax treatments that we can work with here. On the right, we see their income. They take $100,000 of distributions from their trust. Sally does take a $25,000 distribution from her IRA, and they both are receiving Social Security benefits totaling $75,000 in retirement benefits. That comes to a total household income of $200,000 for them. We recently met with John and Sally in January for a portfolio and plan review and decided it was time to trim back some of their stocks and add to bonds due to performance and some cash needs they have upcoming. So we want to take a dive deeper into the tax impacts. What we're looking at here is an output from our tool called Holistiplan to help go deeper into that tax analysis software. A few surprising findings actually stand out here. We saw in the previous slide that John and Sally have $200,000 of felt income to them, but that only comes through on their tax return as $183,000 of gross taxable income, that top line income. After deductions, they have about $138,000 of true taxable income, and this places them in the 12% marginal ordinary income bracket. They have a pretty low average tax rate considering their composition here of different types of income. We also know that they're not exposed to Medicare premiums. You maybe have heard of those as IRMA. Their taxable income is below that first surcharge threshold. So right away, they do have some meaningful tax flexibility here, especially around rebalancing decisions. When we met, it was determined that it was the joint trust account where we do need to do a bit rebalancing there. That is considered a taxable account. So any rebalancing of appreciated positions would realize capital gains. From our analysis, we can see that they now fall into the 15% long-term capital gains brackets in order to sell some of that appreciated stock and purchase bonds per their plan. Holistiplan shows that we do have room to take more gains without triggering Medicare premiums, hitting certain tax thresholds or other income phase outs. With this data, it's really helpful to have some clear conversations with John and Sally about the trade-offs. We know that they might pay a little bit higher taxes today in order to achieve that improved diversification and risk alignment that is right for them. So we came to this conversation initially just focused on that rebalancing. How much room do we have to take additional capital gains? But we know on the tax side, we're always just scratching the surface here. So many different parts of the tax code interact with each other, and it almost always reveals some additional planning opportunities. We could dive deeper into optimizing their charitable giving, talking about choosing between QCDs, qualified charitable distributions from their IRAs, or maybe gifting appreciated stock from the other account. We could also discuss accelerating income in the form of Roth conversions to lock in today's relatively low rates for life. We'll dive deeper with John and Sally about what's the greatest impact for their family specifically. And I think that's really the value of this ongoing planning. We know that thoughtful tax planning doesn't happen just once a year. It's an ongoing, continued conversation, partnering with your Bartlett team to align every financial decision really with your long-term goals, even your generosity and overall financial well-being.
Thanks, Gina. I think that's really great to see how you can put the analysis into action and then take it as a first step and follow on analysis from there. Our panelists have covered a lot of ground here today. To recap, Justin shared about the strength of the equity market and the strong 3-year run that we've been on, also highlighting some opportunities that lie ahead. While international markets performed quite well in 2025, we still see continued strength for international as well as some small cap US stocks here in the United States. John talked about bonds and the positioning and how they can add both stability and income in portfolios given the current yield environment. And then Gina reviewed the importance of revisiting your asset allocation, diving into those goals and objectives, making sure that risk tolerance is right, and then utilizing some important tax planning along the way to support any changes in the overall strategy. And that's really where at Bartlett we want to continue to help you, our clients, is look at that holistic strategy to make a decision on the plan, bring it to action through the investments, and work together on that total planning package. Now, I am going to open it up for questions. I know we've had a couple come through in the Q&A box, but I encourage those of you on here live with us today to utilize the Q&A function at the bottom of your screen to submit a few questions along the way. We had one question come in, Gina, ahead of today's presentation around Social Security. A client asked about the stability and future of the Social Security program and wondered how Bartlett is thinking about potential risks in this space.
Yeah, we do hear this frequently, and I understand the concerns we hear from clients, family, friends, really everyone out there about the future of Social Security. And I think the headlines can be quite scary about the Social Security Trust Fund running out of money. And this can sound alarming, but the details do matter. So every year, the Social Security Administration comes out with a new report on this trust fund. Current projections do estimate that the trust fund will be depleted about 2033, depending on how you combine some of those various sub-funds. But an important fact here that's sometimes glossed over is even if the trust fund runs out and Congress fails to take action, about 75 to 80% of benefits can still be paid from ongoing payroll, FICA taxes, just alone. Now, what happens next? We do think that Congress will take action. We know they need to take action before any adjustments to funding or benefits can come to pass. But historically, and unfortunately, Congress has not been extremely proactive on these issues until they're forced to act near those deadlines. So we keep in close contact with industry partners, and policy experts really do widely expect that Congress will take action, but unfortunately, probably not until the last minute. So a few of those tweaks could be increasing the full retirement age. That age is 67 for most people. That was changed in the 80s, and it was kind of a gradual change. Another option could be increasing the wage base upon which those FICA, those Social Security taxes are levied. So a little bit uncertain in the future prospects, but what we're doing now for clients is we know that we cannot exactly predict the future. So we're building in and have for quite some time, building in multiple layers of conservatism into clients' financial plans, specifically around lower inflation adjustments. We're not quite up to CPI on those Social Security benefits. So that's a layer of conservatism, as well as reducing projected future benefits for our younger clients who are not yet receiving those.
Great. Thanks for that, Gina. Justin, we've received a few questions on the topic of AI. Some clients have phrased it as a concern about the amount of spending and borrowing in the space, while a few others are wondering which companies and industries could be the ultimate winners. How is Bartlett approaching this rapidly evolving technology?
Yeah, admittedly, there's a lot here for us to discuss in the Q&A portion of the strategy update, but I would fully expect this to be a topic where we can dive a lot deeper in our next strategy update. But let's discuss some of the themes that have been impacting markets. The first theme is centered around the ever-increasing level of tech capital investment. We've talked about this a lot at our previous strategy updates the last few years, but it's worth revisiting. Many of the big tech companies have historically been asset light. Asset light means most of their products were provided with just software and a relatively modest workforce. So this is a super scalable enterprise and allows for huge profit margins because costs are relatively low. And you combine that with a super valuable product or service. And under this asset light business model, these companies have been able to generate huge cash flows. Well, here we are in the AI evolution. And in order to build out the AI infrastructure necessary to be competitive, these companies are forced to use the immense cash they generate from their legacy businesses to build out their AI infrastructure, which makes them more asset heavy. And we've seen the market currently kind of coming to grips with this structural transition. And as we've discussed in the past, there's also this dynamic that investors are becoming more impatient for there to be a payoff on all of this investment. So as you can imagine, there's some volatility around these changes.
I think we're even seeing that here today, blockbuster earnings out of NVIDIA, and yet it's not quite good enough for the market. So being mindful of the overall allocations in some of these hyperscalers is an important part of that overall strategy. Can you dig in a little bit deeper, Justin, specific to software companies? I know those have been in the news. Some of them have been beaten up. We're, seeing a rebound in some of those here as of late. Talk to us a little bit about the specific subsector of technology as it relates to software.
Yeah, we've seen the software industry sell off something like 30% from their highs last fall because we've seen these new announcements from companies like Anthropic, where they've announced new AI models that allow for their AI agents to provide industry-specific tools. And that's causing investors to jump to conclusions that the traditional software companies will no longer be as useful, or maybe not as useful as they were in the past. And seemingly all software companies are being beaten up right now. But we feel that the large legacy software companies have a leg up that isn't being appreciated, including their existing enterprise relationships, dedicated customer service, and their credibility and name brand goodwill that comes along with all of that. So in order to truly replace these incumbents, which is what the sell-off is kind of implying, these newer AI models need to provide a better product or outcome with better security and data protection and at a cheaper cost. That's what it's going to take for a chief technology officer to make a change, because these incumbent enterprise software systems touch every part of the business. And it's a huge risk to make such a massive change where you would essentially be required to rip out all this mission critical infrastructure. It's not just simply layering in a large language model over what's already there. That's implying adding and not completely replacing. And so I think the other point of concern is that even if AI won't replace the value that software companies have created, what does it mean for their overall revenue expectations? And some have worried that maybe companies will begin to cut their software budgets, which obviously could impact the software company revenues. And the reality is that the vast majority of what large corporations spend on software as a percentage of their overall information technology budgets is very small. The primary expense is actually physical hardware and their workforce overhead. And there's maybe a world, a realistic world where AI makes corporations more efficient and allow them to reduce their IT workforce, or maybe shift that workforce to work on other tasks. But we aren't of the belief that this will affect traditional software companies that count these corporations as clients. And that's because the large software deals aren't sold on a per seat basis. They're actually sold on an outcome basis. So a company like Salesforce may sell its software to a company who is able to have a smaller workforce to complete the same amount of work, but the Salesforce software and service costs the same, despite fewer seats utilizing the software at the company. So ultimately, we think competition is going to push a lot of the best companies to the top. We believe it may push some technology companies to bring better products to market faster. And we're seeing some kind of rather than Anthropic taking over companies like Intuit or even Salesforce, they're starting to partner up together. Anthropic had a report just this week that said, we're not here to replace, we're here to partner and really strengthen the services that are provided. I think another great example is Alphabet, which really a year ago, Alphabet's the parent company of Google, was thought of as being left behind. Their stock price reflected it. It was really kind of at a trough. But they iterated, they brought out their new AI model, and now feel like they're at the front of the pack. And subsequently, they've seen their stock price soar. It's been one of the best performing stocks over the last 12 months. So we're seeing a lot of this stock price reaction in the software companies, and we think it really reflects more of a sell now, research later mentality. And we think that creates an opportunity. We think there are a lot of software companies that are being written off quickly that shouldn't be.
John, let's shift gears a little bit. We received a question on precious metals and commodities. What's Bartlett's views on the space?
Yeah, I want to think about this from, what we might consider a well-constructed portfolio, and from an opportunity standpoint, we generally don't see gold or silver as really core holdings. And the reason we say this is there's just not a simple way of saying what gold should be worth of in terms of the fundamentals. And I think the same thing can be said for silver. They don't pay dividends, they don't necessarily open new stores, and they don't typically produce what we would consider to be ongoing economic value. If you were to buy gold or silver now, it's really just a bet that the backdrop will continue to favor this kind of anti-dollar sentiment, and we really don't have a great way of guessing whether that's true. And moreover, if that sentiment reverses, we really don't know how bad the downside might be because there isn't any fundamental basis to determine where it could go. So as we think about a diversified portfolio, any exposure would be best through really a broader commodity strategy rather than these standalone positions. Given the generally high volatility in these assets, it doesn't take a large allocation to meaningfully alter the overall risk profile of a portfolio. And I think it's also, when you think about the commodity space, it's also worth remembering that even without direct commodity exposure as an inflation hedge, equities themselves have historically served as an effective long-term hedge against inflation. So without kind of that fundamental basis on where the commodities might go, if you really would like exposure, we would recommend it in a broader basket of commodities rather than a direct investment in, say, gold or silver.
John, we received two other fixed income questions. I'd like to stay with you. The first is, if cash is being raised for expenses, where would you put that cash until you're able to, until you need it for the expenses?
Yeah, you know what? I have never been afraid of just utilizing a simple money market fund. Money market funds are paying anywhere from 3.25% to 3.5%. If there's a potential cash need, say within the next 12 or so months, I would not shy away from just simply utilizing a money market fund. If there's a longer runway that potentially those assets or that cash might be needed, potentially there is some opportunity there that we could utilize. But overall, I wouldn't be afraid of just utilizing a simple money market fund.
John, I'll add to that. I know our financial planning team has done a lot of work with high yield savings accounts as well. We partner with Flourish as one provider of those, and the rate on that is 3.25% right now. So even a high yield savings account can be a place where, for this point in time, before any additional drop in interest rates, can be a good place to be. And I think this idea of what can you earn on your cash is an important aspect to factor in when we think about monetary policy and bringing down interest rates. That can be pretty painful to savers who have gotten used to these nice income levels. So there's a lot of aspects there that we think about. One more question, John, on private credit and the team's thinking and approach to private credit. I know that's been a topic that's been on the headlines here recently.
Yeah, private credit's a tricky one, and you know it's always been a struggle because of kind of the quite simply the lack of transparency that you get with some of these private credit funds. And I think if it can be very challenging because recently what we're seeing, I think, is a lot of private credit investors are very jittery right now. We just saw recently one of the biggest lenders, the name is Blue Owl. They announced that they were selling over $1 billion worth of debt in some of their older funds. They were ending some of the quarterly redemptions in one of them, and I think you're just starting to see really some more jitters come out of this space. And so, it's not a space that we would completely avoid, but I just think you need to be very careful about where and how much exposure you might have to some of these private credits funds. And I think there's just this underlying risk that maybe isn't certainly appreciated in the broader market. It just kind of looks as that new, very attractive, higher yielding investment when you really should look under the hood and make sure that what you're getting into is appropriate for your risk tolerance. But as I think about some of the software pressure that we've seen in the equity markets, well, if you look at the private credit market, I mean, software companies represent a huge portion of the private credit market. I've seen estimates anywhere from 20 to 30% of private credit deals are in the software sector. So I think you're starting to see some pressure from that as well, just kind of given some of the pressures that we're seeing in the software space on the equity side. So it's one of those sectors that I know it's very attractive from a yield and return or potential return perspective, but I still think you need to be cautious on how much you might get exposed to that space.
Gina, one final question here as it relates to electronic tax payments. I know a number of our clients submit their payments to the government for quarterly tax payments or their annual tax payments. What is the impact of some of the executive orders around moving towards electronic tax payments?
Yeah, definitely. Maybe you've heard this from your CPA, but there was an executive order issued last year to aim to help monetize or modernize those payments to and from the IRS. So last year they started phasing out paper checks and paper refunds. This year we're really starting to see that shift and towards making those tax payments to the IRS in a digital format, not a paper format. So unfortunately, guidance from the IRS is still limited, but in this new year, we are seeing a lot of CPA firms, a lot of financial firms are implementing their own processes to move towards those big digital payment processes. And we're seeing from our CPA partners, we're talking internally about encouraging clients and anyone to start using those readily available electronic payments methods that are already out there. Direct pay, EFTPS, or even an electronic funds withdrawal when you're filing your tax return. So work closely with your Bartlett team and your CPA, but we would recommend that you start to make that shift.
Really helpful, Gina. Always best to plan ahead just in case those changes come sooner than what's anticipated. With that, thank you everyone for joining us here today for our winter strategy update. Please follow up with your Bartlett team with any questions, and we look forward to being in touch with you again very soon. Take care.